Hello to everyone. Today I am here with stock and their valuation as a part of business finance lecture 2. In order to grasp the concept, please do watch this video till end. Secondly, if you are interested to have update videos on banking and finance related topic, please do subscribe my channel. We have already covered the following concept. What do you mean by the stocks and constant growth model? Today we are going to discuss about the no growth model. That means stocks are valued on there is no expected growth on dividend to be paid to the investors, and non-constant growth model. Stocks are valued based on non-constant growth on dividend to be paid to the investor. I am going to discuss these both topics with the examples from daily life. No growth model means the dividend will remain the same over the period. If you are going to receive the dividend for rupee 2, it will remain rupee 2 over a period, over a long period. So there is no growth in the dividend. So here G is equal to 0. But we are expecting the return on stocks in the shape of the capital gain by RS. So RS will be used as our discount factor. To instant present value of the stock on the basis of a dividend NAT of 2 with a growth of 10% comes to 20 rupee. If there is a dividend value is 4 and its growth is 8%, in that case, the value of the present value of the stock should be 50 rupees. So it will help you that on which value you should purchase the stock. Second is non-growth model. Non-growth model means you may receive a growth of 5% over first 3 to 4 years. Thereafter, growth may increase or may decrease. When growth rates usually increase, if you find you are expecting that your new machinery will erect and start its production after a period of 3 years, it means the dividend may also grow with the new increase in the production capacity. There are chances you have an order, that order will be completed after 5 years. Thereafter, for a long period, you may not receive such a order. In that case, the dividend growth may decrease. So we are going to discuss both cases with the examples from daily life. First is when there is expectation for the increase in the dividend growth. Here dividend is 2 at the time of purchase of the stock, and there is a growth that is representing by G1, 4%, for a period of 3 years. Thereafter, it will increase to 9%. It means there is an increase of 5% from 4 to 9%. So we are going to calculate the dividend for 4 years. First year is grow by 0.08%. For second year, it grows by 0.16%. And for the third year, it grows by 0.25%. Thereafter, for the fourth year, growth rate changes from 4 to 9%. Now, the dividend for the fourth year comes to 2.45%. On the basis of that, we are going to use the discount factor. First formula is RS is basically the your RS is basically your capital gain growth, that is 10%, and we are using it as a discount factor. For the first 3 years, we have calculated the growth comes to 1.89 for the first year, 1.785 for second year, 1.69 for third year. Total comes to 5.3 365, and for the fourth year we have calculated its value, that is equal to 245. So we have discounted this value as well. It comes equal to 184.07. On the basis of this, we are able to calculate its present value. The stock's present value comes to 189.44. In a similar way, we are going to calculate when there is the expectation for the decrease in dividend growth. It's a second scenario. For the second scenario, we have an example. If the company offers a dividend for 5 at the time of the purchase, there is expected growth of 7% in the dividend for 5 years. Thereafter, the growth rate may dip to 4%, and the expected average return on the stock is 11%. So 11% is the capital gain. Dividend at the time, what is given? Dividend at the time of stock purchase is 5. Growth rate for the dividend for 5 years, that is representing by G1, is 7%. Thereafter, growth dipped to 4%, that is U2, and the return on stock is RS is 11%. RS we will use as discount factor. First of all, we have calculated the first year dividend, that is growing by 7%. It comes to 5.35. For the second year, with the growth of 7%, it comes to 5.72. And for the third year, with the 7%, it comes to 6.12. And for the fourth year, it comes to 6.55. For the fifth year, it comes to 7.01. Thereafter, the growth is dipped from 7% to 4%, and the dividend for the sixth year comes to 7.39. Now, the present value we are going to discuss, we are going to discount all the values with the discount rate that we have used as 11%. The discount rate we have used here. The value come to total value come to 22.4. Thereafter, we are going to calculate the value for the sixth year. Here it is 6. Let me check from the previous case. Yes, it's 6. No. 5. Yes, because here we are applying for the fifth year, we are going to applying the dividend for the sixth year, and it comes 104.14. Now we have discounted this value with the same discount rate, and the value comes to 61.80. So the present value of the stock should be equal to 84.20. In case you are interested to have updation or any clarification relating to these concepts, you can contact me on my email address as well. Thank you very much. See you again with the upcoming video on the finance related educational concept very soon, or you can review a number of videos on different topics related to your academia are already uploaded on my channel.